Hey there, hope you are having a wonderful, wonderful summer. It is July 2024. Yes, it is hot out there, but guess what? That's what happens in the summertime. I'm Brian Bogner along with Greg Towner, and we're here to give you the five charts in 5 minutes, July hot summer edition. So, Greg, let's go ahead and jump right into it.
Yeah, the temperature is not the only thing hot. Obviously, the market has been steaming hot here, rallying to an all-time high as we speak, which is, people have really kind of been pushing back against that. I don't think many people expected the market to just keep going like it has. It's been defying investor expectations. I think you can certainly just argue that we're extended from the 200-day moving average here. We're a little overbought. We are entering, the next 1 to 3 months are historically a little weak seasonally. So sure, we could absolutely see some consolidation now, maybe some rotation under the surface. We'll get to that here in a moment. But those are just, estimates. Sometimes the market likes to defy what everybody's thinking, right?
Right. Yeah, most of the time.
Most of
Absolutely.
the time, yeah.
Yeah.
So, I just alluded to it, but this chart is really interesting, Brian. This looks all the way back to 1980. We are recently at a record low percentage of stocks that are outperforming the market index. So, well, we've talked a lot about there's just a handful of names that are beating or meeting the market, but this just shows it graphically. It's just so few stocks pushing the market higher. Now, we're recording this Friday morning. Yesterday was a huge kind of reversal of that. Small caps and value did great. Growth and large cap did not. And that's just one day. It doesn't really mean that much, but it will be interesting to see if we're finally going to get to the rotation that kind of broadens things out a little bit.
Yeah, I look at this and I'm actually bullish when I see this because it means
Right.
that, this to me is an outlier and it's not something that's probably going to be sustainable, meaning there's going to be more participation here shortly is what is how I'm viewing that for sure.
Yeah, and one of the other big topics that has been the case for a while is inflation, and we had a very interesting CPI number come out this week. For the first time in quite a while, it ticked down just fractionally under that 3% level. In fact, if you look at the month-over-month data that a lot of economists use, it actually showed a negative number for the first time in a while. So not just a slowing growth rate of inflation, but actual negative inflation. So we'll see if that holds, but what it means is the Fed is highly likely to start their cutting of rates at least in September, maybe before that, but probably in September is the best estimate at this time for the Fed to start gradually cutting rates. So when we speak of rates, what does that mean? The Fed rate is kind of loosely tied to all the other public interest rates out there. This is the 10-year yield. It's staying a little bit flatter than some of the other shorter term yields that are more tied to the Fed. It's still trading more or less in kind of a sideways pattern here, but we think it has a little bit of bias to the downside, partly because of the Fed reducing rates, partly because the economy is just on the edges starting to show a little bit of softening here. So we think rates could come down a little, and if they do in a moderate way, it could be a little bit of a positive for, like, say, housing if those rates come down, or people that need to borrow money, small
Yeah.
companies that borrow money. So potential positives if rates come down a little bit.
Yeah, I mean, I think there's a lot of markets that are frozen in some ways right now because of lack of supply and all these other reasons, but it's all rate driven, like you're saying, real estate, small company lending, some of these things. Yeah, and an ease in this would certainly help.
Let's finish on some positives here, and there's a
Yeah.
lot of data here, but we're just going to focus on a couple of things. So we've looked at a number of different studies that look at when you have a very strong stock market in the first half of the year, like we just did, for example, greater than 10% return in the S&P 500, looking at what the market does for the rest of the year, on average, it returns almost 8% with a positive rate of return 82% of the time.
Yeah.
Both of those numbers are notably higher than just the average historical period that didn't necessarily have
Right.
a strong first half. So we are believers in momentum and trend, that strength equals future strength. Nothing is without, occasionally being wrong, but we tend to be, believers that strength equals strength.
Right. Yeah. Yeah. That's good. That's good. That's really good. So, but again, market is a little extended right now.
Yeah.
Look, so a little consolidation here, some sector rotation would certainly be expected. Maybe the leaders of the first half of the year, not the leaders of the second half of the year. That's perfectly okay. And it's still a bullish thing. But the reality is we are seeing a lot of strength. and strength leads to strength. So, this isn't a market you want to necessarily shy away from or run away from or anything. Or, we hear this a lot. Well, it's at all-time highs. Why would I buy here? Because again, over time, which we just showed, strength leads to future strength. So if you have any questions, comments, please shoot us an email, give us a call. We thank you so much for listening today, and stay cool this summer. Bye now.